OK, let's have a look at some of the changes for tax arrangements announced by Wayne Swan last night. The government has, of course, dumped the planned 1% cut in the company tax rate. The previously announced policy to triple the tax-free threshold is included, and because of that move, the government says the standard deduction tax return will no longer be needed. Now, the Treasurer has also announced the government will limit tax concessions on golden handshakes. There'll be now more of silver handshakes, given some of the concessions being cut. The government will also tighten some allowances for high-income earners, such as living away from home benefits. We'll get further reaction from the business community to the budget, particularly the cutting of that planned company tax rate tax cut a little later in the program. But first, let's look at the big budgetary picture. We're joined in the studio by Saul Eslake, the Chief Economist at Merrill Lynch. Good morning to you, Saul.
Morning, Michael.
And also Paul Bloxham. He's the Chief Economist at HSBC, Australia and New Zealand. He's in Sydney. Paul, good morning to you. Firstly, I want to ask both of you, Saul Eslake, beginning with you, is this $1.5 billion surplus credible?
It is on the figures that have been presented, but it is also just a forecast, and as the experience with the outcome for 2011-12 demonstrates, having originally been forecast to be 12 billion, then revised up to 22, then to 37, now to 44, these forecasts can be out. The budget papers themselves show that if, for example, Australia's nominal GDP were to be 1 percentage point lower because of a fall in the terms of trade, and that's something that could very easily happen, then the surplus for 2012-13 and for 2013-14 would be wiped out. If the government collects half as much as it expects from the Minerals Resources Rent Tax, which many private sector analysts think is likely, then similarly the projected surpluses for next year and the year beyond could disappear.
Paul Bloxham, over to you. Do you believe those surpluses can be pretty shaky?
Yeah, I think it looks like a bit of a stretch myself. They are a beautiful set of numbers if they were to come true. They're forecasting trend growth of 3.25% this coming financial year, at the same time as the largest fiscal contraction that we've seen since the mid-1950s. So it would be a beautiful set of numbers if they managed to get the economy growing at that trend pace with that contraction still going on. And as Saul noted, there are a whole lot of assumptions that go into that. A lot of them, of course, rely on what's happening internationally and what's happening to commodity prices. So it's still a forecast, and we need to treat it as such.
And staying with you, Paul, the government was paying up the billions of dollars in extra cash assistance to low and middle income earners. Do you believe that could actually help the economy if at least some or most of that money finds its way eventually to the nation's shops and malls and stimulates retail spending?
There certainly is a bit of rebalancing in the budget, as you described, some support for lower income households, some support for households in general. We've taken away the corporate tax cuts that were previously written in, and there's a bit of a cut. There's a cut to defence spending. So there has certainly been some redistributional aspect to what's going on in the budget. But the one key thing is that the mining sector is still, of course, expected to be the very strong part of the economy over the coming year and indeed into next year. And the mining tax is still relatively small. It really does bring in some fairly small revenue estimates, and indeed those are also questionable. So whether we'll be able to redistribute just from from other non-mining parts of the economy, the corporate sector in particular, to households without slowing the economy more than the government is expecting is a key question.
And Saul Eslake, what's your take on that?
Well, the government clearly hopes that by tightening fiscal policy, it will reap a dividend in the form of easier monetary policy, that is to say lower interest rates, and that's one of the underlying strategic objectives of this budget. Of course, the fiscal tightening isn't as great as the implied 3% of GDP shift in the budget balance from 2011-12 to 2012-13 would suggest. Roughly speaking, a little over a percentage point of that has come simply from shifting spending from the early weeks of 2012-13 to the last few weeks of 2011-12, and that has no material impact on the economy. Second, of the savings which the government is making on the spending side on net, roughly half comes from spending that would have occurred outside Australia on defence and foreign aid. So that too doesn't represent a contraction in GDP or in economic activity. So roughly speaking, the net impact of the budget on the economy is perhaps to reduce GDP by of the order of a percentage point from what it would otherwise have been. And that in turn assumes that we don't see too much by way of the private sector who's hit by tax increases or the non-delivery of promised tax cuts, responding to that by reducing saving as opposed to reducing spending. But I think it is possible that we'll see one more rate cut. And the government clearly hopes that we'll see more than that, in which case the impact of the net spending cuts in the budget won't be as great overall as some people fear.
Paul Bloxham, how much scope do you believe there is for the Reserve Bank to cut those interest rates further, given what we saw last night?
Well, I think if the numbers come out the way the government's projected them to come out, that it's quite possible the Reserve Bank does ease policy a little bit further. But the key question will be, how much does the RBA also believe these projections? How much do they think that will actually happen, given the points Saul made earlier about the fiscal slippage we've seen over the past couple of years? 2 years ago, we were expecting this year's deficit to be about 12 billion. It turned out to be 44 billion. So it is a key question as to how much the Reserve Bank would trust those projections on their face, and I think the RBA is going to be fairly sceptical, at least at the beginning. So I doubt they'll be cutting in advance of these budget numbers, in advance of this flowing through to the economy. They'll be watching the economy and determining whether they should on the basis of what's happening in aggregate.
And a brief question to wrap up for both of you. We'll stick with you, Paul Bloxham. The government has foreshadowed a fall in GST revenues, which of course will hit the states and territories potentially really hard. What do you see as the real impact of that fall in GST revenue?
Well, I think that's going to have a further impact in terms of meaning that the states need to tighten up as well, and so that will, in terms of that, is probably one of the more likely parts of the budget that will be tight.
And Saul Eslake, will it have a really bad effect on the services provided by states and territories?
Yes, and particularly by the smaller states and territories who are more dependent on GST revenue than the larger ones. And it underscores the dangers involved in the push by the big states in Western Australia for the GST distribution formula to be changed in a way that benefits them. The proportionate gain to the big states from the changes they're seeking is much smaller than the damage that would be done to the budgets of the smaller states, and hopefully the government will take up the recommendations of the interim review panel led by Nick Greiner and John Brumby not to go down the path advocated by the big states in Western Australia.
Saul Eslake from Merrill Lynch, thank you for your analysis, and Paul Bloxham from HSBC, thank you for joining us this morning.
No problem.